So build up your intuition and your tolerance. How does it, because it's going to be some days you're going to look at it and go, this thing's stupid. And then other days you're going to be like, oh my gosh, wow, look at that. And you're going to get a sense for that. And then it allows you to build. And this is both at the institutional level and the retail level. This is across all things. When you don't have an intuition for an asset class because you haven't dealt with it. And I would assume, most people are of the age that a lot of times they don't have a lot of experience with gold in the markets today. So they're going to have to build up that intuition. So start small, but start, right? And look at how it interacts with your portfolio.
Hello and welcome to the Get Stacked Investment Podcast, where we delve into the exciting new world of return stacking. Join us as we break down complex financial concepts into accessible insights, speak with leading experts in the space, and analyze real-world applications for return stacking. Get Stacked is here to help you break out of the traditional portfolio construction mold and get you to start thinking differently about the path to successful investing.
Corey Hofstein is the co-founder and chief investment officer of Newfound Research, and Rodrigo Gordillo is the president and portfolio manager of Resolve Asset Management Global. Due to industry regulations, we will not discuss any funds managed or sub-advised by these firms on the podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of neither Newfound Research or Resolve Asset Management Global. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of these firms may maintain positions and securities discussed in this podcast. For more information, visit returnstack.com.
Welcome, everybody, to this. This is going to be a fun episode about gold, Bitcoin, precious metals, all the fun stuff that came out of this unique report. But before I get into it, for those who are new listeners here, I got Mike Philbrick, CEO of Resolve Asset Management and co-founder of Return Stacked ETFs. Myself, I'm president of Resolve Asset Management and co-founder of Return Stacked ETFs. And today we have a special one for us, something we've talked about a lot in the past, Mike, since the day we met. We've been talking about gold. Back in 2011, gold is very near and dear to my heart, given the Latin American angle and us emigrating to Canada because of hyperinflation, 7,200% in 6 months. Man, do we wish we had owned some gold back then. So tell us a little bit about the report that we're going to cover, because it was the first time I've read it. And, you have all these beliefs and it's always been part of my portfolio and clients' portfolios. But seeing the numbers that they put out and everything that they talk about was actually quite awe-inspiring, especially given what's happened recently. So why don't you tell us a little bit about the report, the authors, and stuff?
Yeah, again, it's In Gold We Trust, and the report is done annually. It's in its 19th year. It's published by Incrementum AG, which is a Liechtenstein-based asset manager. Started in 2007. It's in 4 languages. And it really has become the global industry Bible on gold and hard asset themes across the world. And probably because it's such an in-depth report. So there's a 400-page report. There's a summary report of 40 pages, and then there's a video summary as well. All of which, depending on where you are and how you want to, how much you want to dig into it and how much time you want to devote to it, will give you some ideas on how they think about gold. And I think what's interesting is the track record that they have from just going back and looking through. If we look at 2020's IGWT, or In Gold We Trust report, that's when I started really paying attention to the report, just because it was such a good summary of what was going on in the world. And they were calling for $4,800 gold. And, they talk about how a bull market or a market evolves. And you and I know this, we've been around to know that generally you get an accumulation phase where there's some buying, but it's kind of ridiculed by peers, right? It's frowned upon. And I would say really that's been the case up until the last year. Even central banks were selling up until the last couple of years. Institutions have fairly small allocations. But I think we've transitioned into the public participation phase in the last year, where you're starting to see some people pay attention. And I evidenced that from some of the ETF flows we're seeing in North America finally coming into the asset. Whereas I remember us talking about it last year, where gold was on quite a run and having reasonably good performance, and AUM in the large ETFs and
Yeah, it was going
ETPs
down.
was going down.
Not moving,
Right.
which is
It's
absolutely crazy.
insane. And
Yeah.
that was part of that stealth market where you get that sort of interesting buying. That's sort of, there's a transition happening. There's people that are sick of holding it, and there's the new people that are in. And so that was interesting. And last year's theme was the new gold playbook, which was the idea that, emerging markets are going to start to demand this. They're going to demand alternatives to the US dollar. And, we saw that over the last year. We saw countries like Poland becoming a major buyer. 2023 was 1,000 tons, I think, of gold bought by central banks, which was the highest ever. And gold ETF outflows reversed in sort of that second half of the year. So we're starting to see the public and the public writ large, both institutional and retail, catch on. So this year's report is called The Big Long, which is an homage to The Big Short. Obviously refers to the same sort of, the big long is like, well, be long gold because there's a loss of trust in fiat currencies and institutions and global monetary systems, right? That, long-term assets like gold and Bitcoin are somewhat of a contrarian bet, but we're probably now in the fifth inning, if you will, in the middle innings. And, institutional allocators, family offices, pensions, and retail investors remain heavily underweight. And so, by the way, In Gold We Trust report, if you put that, just Google that, you can get this report from Incrementum, and it's free and there's no obligation. They don't take your email or anything like that. So it's quite a good report. Got lots of great stuff that we're going to dig into, and I encourage people to take a look at it.
So let's start with let's start from the beginning, okay? Because this is something that I get asked a lot, and I think it's an important starting point, because as investment professionals, we are often asked to think about investments from the cash flow perspective. What are you investing in? What are the cash flows? What are the dividends? What's the yield that you're going to achieve from these? And that's ultimately what you end up getting paid for taking the risk and whatnot. Yet gold is not any of those things. Gold is just this thing that just doesn't seem to go away. For thousands and thousands of years, we have used it as a society. It shouldn't have a positive real rate of return, and yet it's exhibited pretty robust real rates of return, especially in the last 40 years. Why is gold a thing that we should care about? Like how did we get here?
Yeah, it's a very interesting question, and one that's hotly debated. To some degree, I look at it and say, well, does the Mona Lisa create cash flow? Does it have value? So if you look at it from the perspective of the Austrian School of Economics, the idea of cash flows is something that's looked at a little bit differently. So I guess I'm not actually sure. I'm not here to make that argument from the standpoint of, hey, it doesn't have cash flows or it does. What we do see, though, is it's a monetary asset, and it's a monetary asset that seems to be in demand by central banks, which are running our monetary system. And it is an asset that over the last 5,000 years has represented an interest, an asset that does not allow an interest of somebody else. It's not rehypothecated. If you own it, you hold it in your own hands, it's yours. And it has some value of transaction. And that transactional value is happening between governments, between people, been around for a long time. So I guess I'm just not going to fight it and die on the rock that says, well, it doesn't have cash flow. There's a lot of things that we buy in this world that don't have cash flow that we perceive to have value in some way, shape, or form.
Yeah, and it seems, look, I remember having Michael Green on the podcast and having him lay out the case originally why gold, because we've had many stores of value in the past, right? We've got salt and silver and different types of metals, but gold ended up being one that was plentiful across the whole crust of the planet. So it seemed to pop up everywhere. So if you were anywhere in the world, you somehow mined this beautiful metal. And then when trade began, that was the one common area that people could kind of see that was a medium of exchange. And then when you have every culture have gold part of their ethos, right? We go back to the history of Latin America, India. I think it became ingrained as a store of value, and we have now created a whole financial system around it. Central banks own it, and every single time when we studied gold, it seems to be a very important hedge for global macro volatility, right? That's number one, and then currency debasement. Those are the two elements that you can kind of count on when governments screw up from a fiscal perspective, or when there's war or chaos globally. We have seen a run to gold. Normally, it's a run to the U.S. dollar. The reserve currency used to be the UK currency, and before that, many other nations that existed, but that took that reserve currency dominance. But when the government itself started losing control of their expenditures, gold was always a place that seems to be there for investors. So from my perspective, it's just something that we have observed that does well. When I look at portfolio construction, I want things that make money over time but act differently and create some sort of hedge for different scenarios that bonds and equities can't do. And we are, it was stealthily making money for a couple decades, and now people are starting to pay attention, which is interesting, this accumulation phase that you were talking about, right? Now, let's get into why the recent run up in gold. You talked a little bit about it, right? But there's a structural reason, and then there's some fundamental reasons. I just talked about some fundamental reasons, which is global macro volatility. That's certainly been an important thing that we've seen in the last couple of years, right? With the Ukraine war and what we're seeing now with Donald Trump. But then there's also the structural area that that you also address. And the structural area is how much, it's almost like the stock to flow idea, right? Like, there's only a set amount of gold. There's 1.5% of gold being mined year over year. And then, there's another stat that I saw recently.
And it costs money to mine that gold.
And it costs a lot of money to mine that gold. And the price, it's a 10-year cycle to mine it. And the incentives to mine it were the prices of 10 years ago, when they're like, okay, what's the price now? We'll start the process of opening up this mine. And from a structural perspective, it's just been interesting to see. I didn't even know this from the report. I'll push it up here. What percentage of, let me ask the audience here, what percentage of people's portfolios, of investors' portfolios, do you think that that gold represents? If anybody wants to guess. We'll give it a couple of minutes while I pull up this slide. Share my screen here. Anybody have an idea? We got a 3, Lance Nuth, and it says 3%. Then we got a 1 and a 5. All right, I'm going to share my screen here. Yeah, it's actually around 1%, according to this gold report, right? So you're looking at, out of the alternative sleeves, that you got a 42% of the whole alternative asset class, private equity, private real estate, the infrastructure, art, and commodities. Gold is just 1%, right? So, and there's a lot of room to run here given that we have had zero adoption for all this time, and people are waking up to, it really is the only asset class that has done really well this year, right?
Yeah, and I think there was there was that whole process where there was gold trading at a different price in London versus Shenzhen, China, and you saw gold moving from the east to the west, and I guess from the west to the east.
From the west to the east,
From the west to the east, rather. And so that was where we had that stealth buying, right? And now you're seeing it more proliferate into, and we didn't see it in AUM on ETFs like GLD, for example. But now you've seen that. And I was talking to a reporter with the Globe and Mail in Canada, and we had done a review last year on this very topic. And it was just interesting to go over it again and see this change in regime from the standpoint of central bank buying of the assets.
Because and this is the one that you talked about, right? This is the cumulative gold ETF holdings.
Right.
going flat, and then all of a sudden, you have this demand, like the price of gold going up, and only now it's starting to
Yeah.
pull retail demand for it.
Yeah. So the point is, it's not too late, right? So if you only have a 1% allocation or you have a zero allocation, then, this is something to consider. And, at the moment, as we sit and chat about this on May 23rd, we've got a little bit of digestion going on in the gold market. So it sets up the opportunity to start to think about how you might add assets, hard assets like Bitcoin and gold, and how they might complement the portfolio. But yeah, it's astonishing how low the exposure across the asset allocators it has become.
Here's
And
why it's
in
astonishing.
spite of the performance,
Here's why it's astonishing, right? Because this is a chart that got me. I'm like, if I would have shown anybody, this is just for those listeners where I'm looking at the performance of gold against different currencies from 2000 to today. And it's just a sea of green. It's not like other non-correlated asset classes that tend to have, 50% of the time, like commodities, or 80% of the time they're losing money, 20% of the time when there's inflation, they're making a lot of money. Like gold has had a phenomenal run, fairly consistent. Volatility is similar to equities, 15% annualized. Well, it's actually lower than equities. And yet, if I'd shown you blind these returns, you would have jumped at this opportunity until the moment I say it's gold.
Mhm.
Right? And there's just this stigma about gold, in spite of the fact that we had ETFs, central banks buy it, everybody knows about it. There's none of it in people's portfolios. So this is what.
Well, the interesting thing is it's going to be neat to watch the narrative for investors change, right? Because now we're in the public phase of it actually creeping out into institutions, creeping out into retail. And then the question is, of course, how do you put it into your portfolio? How are you going to build it into your portfolio? What are the steps you might take to do so? And what other assets might you use that have similar characteristics?
Well, it's terrifying right now. Let's be honest, right? You got a 25% return last year, another 20+% return this year. This is why I like the report, because you always want some framing. Okay, where are we? Is it over?
Right.
Is it now like a 50% bear market for the next 10 years? And so, some of the key elements about the report was how even like the US 30-year yield is higher than, we've seen it in a long time. And then Germany, the last holdout of prudence when it came to fiscal spend, just finally threw in the towel. And you've seen German bonds yields just pop through the roof. And so,
and what do we know, or what have we perceived about the relationship between real returns and the price of gold? Previously, higher real returns meant lower gold prices, right? Because you could get a real return. But in the face of rising yields, you have gold strength. That to me signifies a kind of regime shift, that this asset, and they refer to it a little bit here and there in the report, is like, are you playing offense with this asset, or are you playing defense with this asset? And previously you were playing defense, right? This is a defensive asset that would actually score a few goals for you. But now it looks like it's turning into an actual asset that can create returns for the portfolio. It's shifting, and there's a regime shift afoot as we change into the public participation part.
So let me show you a chart that I was updating today that we used to use a lot, you and me, Megan. I'm actually going to block off some of it first, because I'll show you what I used to do, because I was quite, again, I know this. It's just when you see it, right? It becomes a little bit surprising. But I used to always, when I talk to investors, look, you should be as diversified as you can. You're currently in equities and bonds. You should probably be invested in as many non-correlated things that are fairly liquid, right? And so I would show a chart from, well, that's why I don't. Anyway, I would show a chart that showed equities, gold, commodities, and currencies. And let me see if I can bring it up. I'm going to bring up an old chart here, but they all ended up at the same spot from 1990 to today. So this was from 1990 to 2021, 2023, you can see how, you know, they all kind of ended up at the same spot. That dark blue line is an equal risk portfolio of all of them. But since then, the treasury component has just plummeted, right?
Mhm.
It has been like, this is the next chart here. Like that blue line has just, this is a 30-year treasury, just
Yep.
absolutely plummeted and flatlined from 2023 to 2025. And the winner ends up in the most recent period to be gold. Just
Right,
again,
which follows a
moment of
period, right,
diversification.
2011, when gold peaked in its last run,
Yeah.
right, to, what was it, last year at probably around this time. That was a 14-year, 13-year sideways market in gold. And maybe we're on a 13-year sideways market in bonds.
Yeah. I mean, it has happened before, right? And few people
Absolutely.
know this, but what was the largest drawdown in real terms for treasuries? This is my favorite Meb Faber quote. Is like 65% drawdown in real terms.
Mhm.
Right? Absolutely bonkers. And what did well at the time, you know, this is way back in the 1900s, but at the time you could have invested in gold mining stocks. I actually did it an analysis because gold was pegged, but if you invested in gold miners, they did fairly well. Which is something that the report also talks about,
Yep.
in an interesting kind of transition away from gold. Like, what did you garner from the gold miners part?
Well, kind of that old Don Cox saying, right? When those who know it best like it least, you got a buying opportunity. And I mean, if there's something that has disappointed more often over the last few years as gold has actually appreciated, and to see whether you're looking at, you know, broad-based ETFs, GDX, GDXJ, the juniors in gold, they really have not felt that participation. You know, there's this old, you know, if you get this gearing from gold stocks that you sort of get like a 3-to-1 leverage when you buy gold stocks versus you know, just owning the gold. And we haven't seen that. We've seen sort of 1-to-1 participation with a lot more volatility over the last year, call it. And if you go a little bit further back and say, well, let's go back 3 years, what you see is, you know, the large cap gold stocks are up 65% and gold's up 80, right? So the stock side of it has absolutely underperformed the physical metal side, but there's a lot in there. When those gold companies are producing, they sell a lot of the production forward in order to make sure they can make ends meet. And when the price is kind of languishing from 2011 to 2023, you end up selling a lot of your production forward just to kind of get by. And then you start to get into a period where, like you said, Rod, it's that 10-year cycle. You got to build a mine. In order to build the mine, you want to take some of that financing risk off the table. So as you're building and producing, you're selling forward your production in order to make sure you've got that locked in so you can run your business. So very interesting. And it seems to me that, I don't know, maybe that area is due for some catch up, but that's always a bit funny too, right? And you and I know that there's the beta in gold stocks and then there's the gold in gold stocks. And when you mix the two, you know, again, I think Incrementum did a great job on, here's an interesting portfolio of how you might incorporate commodities in gold and silver, and thinking like silver and gold stocks and silver stocks are more of these kind of more offensive, like higher geared opportunities, which they absolutely are, which means they have more downside risk too.
Assuming you can't lever up the thing you want to lever up the most. Like, this is the basis,
Precisely.
the basis risk that you take. Like, do you believe in gold and what it's going to do? Well, yes, you could trade all these other things because you get more volatility out of them. But for guys like you and me that love futures contracts and want to in order to get a better portfolio construction, we can gear it up. I'd rather gear up that main asset, right? So that's my only
the main factor, right? If you like you've got operational risk. So you're going to buy a company that mines gold. Well, there's operational risk there. You know, tailing ponds go wrong. The shit's not there.
How much of their gold exposure that they hedge?
Yeah,
right. Like,
exactly.
And so you're not getting the upside. It's just you're taking on pro-cyclical risk. that is
Yep.
correlated to the economic cycle. So I'd rather just buy the pure gold. Even silver, right? Again, I think it's more about gearing,
Yeah.
but silver ends up being more of an industrial metal. And
Yes.
so there's going to
More
be gearing.
economic sensitivity, right?
Yeah.
Yeah. So you want that unique orthogonal nature.
Yeah. And I think let's kind of transition a little bit toward Bitcoin, right? Because this is kind of what's been termed as the new gold.
Yep.
And the debates I've been part of many debates that people saying it's 100% gold. No, it's 100% Bitcoin. Bitcoin has the same qualities, but you can transfer it quickly. You can have it in low quantities if you want to. So you can have, um, partial shares. You can travel with it without anybody having to declare. You can walk through borders with all this money in your pocket, in your brain, like all these benefits of the new gold. So what are the similarities, and where is the risk there of the new gold?
It's a great, and you and I are largely yes and people, right? I don't think it's an or question, right? I think you can incorporate both, quite honestly. But as you say, so does Bitcoin have central banks around the world buying it in mass amounts? Starting, but not yet.
Well, that's another thing they
You
covered
get
in the
El
report.
Salvador. Yeah, you're starting to
You have the
see.
crypto czar of what's his name?
Yeah, El Salvador and
David
whatnot.
Sachs. El Salvador making
Yep.
it some.
Yep. So it's happening, right? So if we set the table, so the market cap on gold is, call it 15 to 17 trillion. The market cap on Bitcoin is 1.3 to 1.5 trillion. So call it 10x. So gold represents 10x. It's been around a lot longer. Probably makes sense that that's the case. There's just different features to these two asset classes and a different sort of track record. And I mean, by track record, I mean, historically, gold's been around for a very long time. Bitcoin is the new kid on the block. And I think they both offer some very interesting and unique characteristics. One is that gold, has a historical volatility of 10%. It moves around a bit, but it's not like gold, where it's like 80. So volatility is just how much it goes up and down on a random.
That's my framework for it all, right? I'm not fully like you're a lot more sold on this being a wave of the future than I am. I got to be honest. But let's just go through the similarities. Okay, so it seems to have that same idea that it's widely distributed around the globe, so anybody can get it. Anybody with a computer, which is most of the population now, can get it. It is an asset that every 4 years the amount that can be mined gets cut in half, right, until there isn't more to mine, and so it becomes this asset, a scarce asset that will go up and down depending on whether humans actually care about it or not. Much like gold, right? We couldn't quite pinpoint anything for gold except for the fact that we want it and humanity uses it, and everybody's got broadly distributed some gold. So, but 5, 6, 7 years ago, the volatility of Bitcoin was 120.
Oh, yeah, well, of course.
Gold's been 50. Then it's gone down to 100 to 80, and most recently going down to 75% annualized volatility. Now that is a lot, right? But this is my framework for it. So I like to use it in my portfolio as a currency debasement trade. But I'm always willing to have that go to zero. I do an equal risk approach, and we can talk about. I'll show you some slides that I've shown already in the Resolve Risk podcast back in the Christmas episode with Meb, Corey, and Wes. But if you're right, the volatility of Bitcoin will, as it gets more and more adoption, the volatility of Bitcoin will go lower and lower and lower. And if you're managing that kind of currency debasement portfolio and equal risk, then that Bitcoin portion will get higher and higher and higher. If I'm not saying that I want to be right about this, but let's say that the other side happens and Bitcoin becomes less and less of an option. There's some issues, they get hacked. The volatility of that asset is going to go up and up and up back to where it was in the beginning until it goes up so high that from an equal risk contribution perspective in my portfolio, it becomes a non-allocation, right? So the volatility to me gives me all the information I need to require an asset that I think is very interesting, very, very interesting. But we can manage the risk by not having a static allocation and hope for the best. You know what I mean?
Oh, yeah. And also your initial allocation, So in your context, you say, well, I want some hard assets in my portfolio because I see a lot of what's happening in debt. I see debt monetization. I see fiscal dominance, and I see some things that are somewhat concerning. And I'm getting the confirmation of strangers through price, both price in Bitcoin and price in gold. I have confirmation of strangers, and that more people are buying and selling. It would seem that's why the price is rising. So I like all of that makes sense. And then to say, well, then how much? So if you have some position in your portfolio, let's say you've got 10%, is kind of an easy one. People say 10% in gold. I don't know. I don't know how we got there, but that might be right. Might be not right. But if you got 10% in gold, then okay, what does that mean for a Bitcoin holding? Probably something in the neighborhood of, why wouldn't we do 10% to the both assets where you've got 8% in gold exposure and 2% in Bitcoin exposure, thereby equalizing those two exposures. So you've got equal risk coming from them, and incorporating that both the old and the new into the portfolio from the standpoint of diversifying the portfolio. I think at this point, we can probably suggest that Bitcoin is a bit more of an offensive player, right?
Well, I mean, it is in that, like in
created
2020, it didn't do what gold did, right? Gold went
Yeah.
up.
Yeah.
In 2020. And so, but this year it's acting interestingly, right? It's actually
Yeah.
doing offsetting gold, and gold has a bad
Yep.
period. So let me show you the original.
And gold having a trend while Bitcoin was kind of languishing around the highs and having pullback. So they're very complementary to one another as well. So again, I think it's not an or. And then the next question is, as we're purveyors of the concept of return stacked portfolio solutions, well then, why do you want to even give up your stocks and bonds that you know, love and trust?
But before we get into that, let me just kind of,
well, that was just a teaser.
Yes. Let me just address kind of the concept of kind of equalizing risk here. And I did this at a time when everybody was saying you should either be your Bitcoin or gold. And I was just showing people how unfair that comparison is given the volatility, right? So I started a reasonable period where, Bitcoin wasn't absolutely insane. So 2018, just to show that, yes, indeed, Bitcoin has done 20% return versus gold during that same period had done 10%. So this is a little old. This is back in December of last year.
Still relevant.
Sharp ratio around 0.6 for both of them, though, right? So what does that mean? It means that if I were to scale gold up to the same level of volatility of Bitcoin, which can be done with a futures contract, right? This might seem a little insane, but it's insane to invest 100% of your assets in an 80 vol product in the first place. If you're that type of person, you can also just easily lever up a gold futures contract 5.7 times, I think was that what I ended up doing there, to hit the same level of fall as BTC. And now we're looking at better returns from gold during that period. And in fact, if I were to, we now know that in 2025, gold's actually killing. So the question is, maybe gold, right? And of course, my answer is, why not both, right? If you were to equal risk this, again, you're equal risking, you're grabbing, instead of 5.7%, you just buy 50% of Bitcoin and 285% of a gold futures contract, and equal weighted and rebalance. And guess what happens? Because the correlations, what's interesting is that they both seem to be good for currency debasement stuff, but their daily correlations is on average 0, sometimes negative. And as you and I both know from Shannon's Demon and the rebalancing premium, that when you have two negative correlated assets that, in this case, end up both making money, and you're able to rebalance from them, you create this rebalancing premium. And so what's interesting is that by putting this portfolio of equal risk together, your volatility goes from 80 to 61, but your returns go through the roof. Your returns are significantly higher because of that rebalancing premium. Your Sharpe ratio goes up, right? So again, this is a portfolio construction over ethos or, a gold religion or a Bitcoin religion. It's just you like them both, put them in equal risk. Now, I am not going to invest in an 80 ball anything. I'm not going to invest in this portfolio I'm showing you, right? And so what an average investor could do is what you just described, right? Instead of levering up your gold, lever Bitcoin down to equal risk to your to your gold allocation. So you could do that by just looking at the market cap of gold versus Bitcoin, which I think is like Bitcoin's what, 10%? You mentioned it earlier, 10%.
10 to 1. Call it 10 to 1.
Right. So 10 to 1. So that's, 90% in gold, 10% Bitcoin. When you do equal risk contribution, it used to be like 7% when you start doing this with Bitcoin in the beginning, and now it's like bumping up to 15 to 20%.
Yeah.
And it'll vary depending on like volatilities expand and contract, correlations expand and contract. But I think that given that they're around the same theme, I like that they're non-correlated. Even if you like, the people talk about silver and miners, they're too correlated to be able to benefit from the non-correlation. If you can get the leverage if you wanted to from just using this, I like the fact that it's Bitcoin and gold being so non-correlated that they're creating their own return stream
on a day-to-day basis, right?
You got to
really are. And it stems from the fact there are very different buyers that own both of these assets still. And Bitcoin is going through the institutionalization. I mean, gold has been institutionalized many, many moons ago. And so it's an interesting juxtaposition about the new and the old, but both have, finite supply. Building new supply is hard, costs money, whether you're mining Bitcoin or you're mining gold, whether you're trying to, get the machines to solve the problem or get a contract approved to develop a site to mine gold. These are hard things, and they cost money to do so. But again, I also think there's a very different group of buyers for each of those if we look right down to it. And the individual investor doesn't really have to think through that in the sense that they have access to the products, right? You have
in a way they didn't a few years back, right? Like
correct, right? You've got financialized Bitcoin products, whether they're through ETFs, whether they're the futures markets, all allowing you to build in this unique asset class. We've had that in gold for some time. But again, combining those two together, bringing both the old and the new together and thinking through not letting the maniacs run the asylum, right? If you say, well, I'm going to give you $1 of gold and $1 of Bitcoin, that's fine too. But, you're largely going to be dominated by the higher volatility asset, which is going to be Bitcoin. But if you're thinking through an allocation from the perspective of, well, I've got some gold and I'll sell a little bit of my gold and buy a stack of gold and Bitcoin. Well, then you've got your Bitcoin stacked on your gold, which you could do.
It's interesting. I just remembered and pulled this up when we wrote the paper on the rebalancing premium, like something about risk parity. In the beginning, we did an analysis on the correlation between just 3 assets: gold, stocks, and treasuries. And so you can see that the correlation is very low just within gold. And what's interesting here to point out is that if you just do the compound returns of the portfolio, like just an arithmetic addition of what they would do in a portfolio without rebalancing, you're looking at a 6.7% rate of return. The rebalancing between gold, stocks, and treasuries, which are not, the correlation is pretty low, you're looking at an extra 1.2% per year in that portfolio. So that portfolio with daily rebalancing compounded an 8% rate of return. Now add another hyper non-correlated asset, because it's also, low. It still has low correlation to treasuries and stocks. You're just adding more rebalancing premium, which I love.
Yep. And that's a really interesting time period too, June 82 to 2020. Right. So you've got gold peaking at that point. You've got rates peaking. So you get a great bond bull run, but you get a pretty vigorous gold bear market, right? So it's still, even though those were more persistent trends throughout that period, that 38-year period, you still came up with wonderful rebalancing opportunities between the asset classes. And that's such a wonderful thing.
And here's why this is important, right? Here's why it's important. This goes back to Antti Ilmanen, and when we brought him in to speak about commodities, right? And this view that commodities has a zero real rate of return on their own. But when you create a commodity portfolio and you weight them appropriately and you capture that rebalancing premium, guess what? Now you have a real return, because you've basically extracted a yield from non-correlated asset classes, right? So in a way, like, yes, we started the conversation by saying, what type of yield does gold provide us? what type of yield does Bitcoin provide us? And they don't. But if you structure your portfolio the right way, if you include them in your portfolio just a little bit, you're already going to be capturing an excess yield that is, this idea of that 1 + 1 = 3, right? Like this is the whole is greater than the sum of its parts.
And the systematic nature of that, right? You don't have to be super smart to just do your rebalancing. I would say that the challenge, I guess, on the behavioral side is it's uncomfortable to rebalance sometimes because you're selling what's working and buying what's not working a little bit. But
Sure.
that does work over time. And if you're going to sin a little, as I think Rob Arnett says, if you're going to sin a little, go for it. Let
Let's talk
it
about
be over.
saying a bit more. So let's go into other ways of doing portfolio construction. Because I think ultimately what we discovered in trying to get people to add diversifiers to their portfolio is that they don't want it. It's too different. It's too hard. Even as I showed that incredible run that gold has had since 2000, people are still reticent to own something that different that they can't understand, right? So I think the advent of return stacking and all the different products that are coming out that allow to stack things on top, give people an out, right? You now have an option to possibly not have to sell your favorite toys, sell your core stocks and bonds in order to make room for these weird diversifiers. You can now actually just keep your 60-40 or 80-20 and just add the diversifiers on top. Yes, in this case, volatility is likely to increase a little bit, but you don't have to go 100%, right? You add a 10%, 20% allocation, depending on what your view is on currency debasement and continued global macro fears. It's a great way to, yes, and the problem.
I totally agree. And I kind of think that if we are honest with ourselves, the math makes sense. The returns are better in gold. They were last year, yet no one gave a right? Why? Well, there's a huge behavioral aspect to this. Are my friends doing it? My friends aren't doing it, and I'm not feeling the pressure of those peers and the what do they call them, sort of best practices. Then it's okay that we didn't hear it from anybody that, oh my God, gold did X and your diversified fund did Y and that was less than X. No one ever says that. Right now, the darling in the room is the S&P 500. We've been around for a couple market cycles, so it hasn't always been that. BRICS in 08, and then the US back in 2000 again, and you go back to 82 and it was gold and gold stocks. So there's this huge behavioral tax that people pay waiting for that public adoption, right? They're not in when there's a stealth opportunity, when you could be in if you were just simply rebalancing or stacking or doing something that allows you to participate in the markets that your friends are participating in so that your tracking error is lower, so that your behavioral biases don't undermine your success, versus taking the big plunge. We just talked about, the numbers from 1982 for crying out loud. Like, it makes sense to have some gold in your portfolio, yet the allocation by pension funds, family offices, large sophisticated asset allocators is a sub 1%.
Yeah.
Right. We all are humans, lemmings.
I must admit, the whole community is a little weird. You know what I mean? Like it's all those guys.
But I'm not talking. This is the funny thing, right?
I'm not gonna.
We get painted as the gold
judged.
Community. I'm a centrist here.
Totally
I'm
judged.
not a gold guy. I'm a centrist. I'm like, you should have some because it's different, because it adds value.
That's it. Like I can get behind it from a portfolio construction perspective.
Correct.
You and I have met a bunch of advisors that have been all in on gold, and good for them. But they've been all in on gold, like 100% of
for a
everything
long time
around precious metals. I mean, we grew up with Eric Sprott.
Oh yeah, being Canadians.
Yeah, right. Like that's all that was.
And you're Peruvian from
Yeah.
So natural resources and gold are well ingrained. They're probably more acceptable to us as investments than a lot of people in the U.S. And we do see that. Like, we see that in the numbers. And I guess that this is where, in that public stage where it's going to start to be okay as an allocator and an advisor to start incorporating gold. get this, it's going to start to be okay. You're going to be able to actually do that and not suffer the slings and arrows of being considered a weirdo. So that's something to consider, that the pendulum, the behavioral pendulum is swinging. It's a little bit more centrist. The gold has some returns that back it. We've got a number of concerns that gold can respond well to, whether those are geopolitical concerns, whether those fiscal dominance, monetary. There's some things that evolve to make gold sort of a key part of the portfolio, especially as bonds start to potentially falter. So it's going to garner some acceptance. So now how are you as an allocator or an advisor going to start building that non-correlated source of returns into portfolios? Bitcoin's going through the same evolution, starting from a much smaller base, obviously. But again, how are you going to think through allocating to these types of things in your portfolio? Do you want to take some of the things that you know, love, and trust out, sell some of your stocks and bonds, and do diversification through subtraction? Possible. Or do you want to do diversification through addition, where you
Well, let's
stack
talk
them on
about
top?
that, the difference between those two from a behavioral perspective, because I don't think that gets enough airtime in terms of when you, let's say, everything, Trump solves everything. We take care of the debt. The U.S. becomes a reserve currency again. Everybody starts behaving. No more wars. That's obviously going to affect gold negatively. And if you've chosen to have an allocation of gold, if you've sold your equities in order to get gold, you're not only losing whatever the 20% that gold might give you, you are losing out an opportunity cost of that equity component that may be up 30%, right? So you're getting a double whammy in terms of allocating when you make room in your portfolio for these diversifiers. Whereas when you stack them on top, you're at the very least not having that opportunity cost of owning the equities in case they go up 20%. You're still having a little bit of tailwind, but you're certainly cutting it by a lot, right? So in terms of wrapping your mind around adding weird things, I think everybody here knows that that we think that a good solution here is stacking, and then you got to decide when, right? That's right now, even though I've been an advocate of gold from the beginning of my career, when people come to me now and they say, should I allocate? And I'm like, yeah, you need to allocate. And then I have to go back to these reports and be like, okay, what's happening? Like, why is this why should I not be timing this as much as I want to? And just the evidence is so, like, even the Chinese government with the capital controls, nobody's going to invest in, like, a few people invest in the stock market unless they're really gambling inside China. Apparently, the only thing that they can invest in without a lot of control is gold. And that's a large part as to why all of this is happening. And as they become more insular, I think that's another interesting secular trend. Latin America, emerging markets are buying more and more gold.
Well, that was the theme from last year, right? That would start to happen. And the theme this year is now it's the big long, right?
It's broad acceptance. Now
we're getting,
I mean,
but this is the part where when you get the broader acceptance, you're now going to start to get the green light, whether you're an allocator working with an institution or pension fund, or you're an advisor working with individual families. You're going to start to get the green light to be able to incorporate this and not sort of compromise the relationship, right? Not call into question the relationship for doing something that's too weird. And that's a real challenge in managing assets on behalf of other people. Is, you want to do the mathematically correct thing, and the preferences of the individual investor sometimes get involved and don't allow for that to take place. That's about as common as anything in this business.
And one thing that I've learned quite a lot from when it comes to macro cycles is Bob Elliott, who constantly reminds us about how long it takes for macro cycles to actually play out. Right? They take years, if not decades, to fully play out to their maximum extent. When, like, even the recent disinflationary growth period where equities kept on going up, right? It was like there was a straight line with a low volatility. Bonds, 40 years, like, these are long secular cycles that we've seen, and bonds have finally broken, right? And it took 40 years for them to break in any meaningful way whatsoever. And so when you think about just the concept of, okay, price of gold is up, Well, there's going to be all this demand. Where are we going to get the supply from? Nowhere. It's going to take 10 years to build more supply. You know, I'm not seeing any commercials to sell my gold jewelry to get gold.
Not yet.
Right?
That
Like,
will be a sign, though. Yes,
that will definitely be a sign, right?
when they start
these are
melting down the silver,
when you
the
start,
silver forks and spoons.
yeah. So when I think about it that way, that gives me, okay, I need to have this as part of my core strategic portfolio. Right?
Yes,
It's not going to be a fun ride on its own, but it is a portfolio.
Yeah, and allocate. This is the nice thing. You can allocate it into the portfolio over time. Like, you do not have to take the approach that today is the day where I'm going to allocate the full X amount.
Yeah.
Right. So let's say you come to the conclusion that, well, all right, this is an asset class that I probably should have 10% in the portfolio. So what are the steps I'm going to take? Well, let's buy 1% today. Let's get it on the books. Let's get started, because when you own it, you watch it and you get familiar with it and you get some intuition as to how the asset responds in different circumstances. And that's always something that's a bit challenging and unique when something has gone through the process of becoming a 1% allocation across investors' portfolios. They're really not paying attention to it, right? So build up your intuition and your tolerance. Because it's going to be, some days you're going to look at it and go, this thing's stupid. And then other days you're going to be like, oh my gosh, wow, look at that. And you're going to get a sense for that. And then it allows you to build and this is both at the institutional level and the retail level. This is across all things. When you don't have an intuition for an asset class because you haven't dealt with it. And I would assume, most people are of the age that a lot of times they don't have a lot of experience with gold in the markets today. So they're going to have to build up that intuition. So start small, but start, right? And look at how it interacts with your portfolio. And then, in our, as you mentioned so eloquently already, our perspective is you don't need to sell what's in your portfolio to add these diversifiers. Just stack them on top, and that will help alleviate some of the tracking error that comes from those times when those main assets are doing great.
Yeah, I mean, I think we're moving the needle, Mike. I think we're going to take this from 1% to 2.
Let's do it.
I'm feeling it this time. It's good because we literally have had this conversation in every room that we stepped in since the day I met you.
I know, and I feel as though like I get painted as a gold bug, and I'm a gold centrist. I'm not a gold bug.
We don't have outrageous weightings of gold in our portfolios.
Not at all.
It's just not zero. It's not zero.
Exactly.
We still have a bunch of people waiting and watching. I'm just curious if anybody has any questions. I'm just going to go up and see if there were any. There are some things we can't discuss here. Volatility drag, a problem with UGL on daily reset. Okay, so UGL is a double bull, I think, right?
Yeah.
So
that's you go for it.
We've discussed volatility drag quite a bit. There's a couple articles on the Return Stack site. If you look up volatility drag, you'll get to understand a little bit more about whether it's even a thing that you need to worry about from a portfolio construction perspective. Like, there is no shame in using 2x levered anything as long as you are rebalancing and you are rebalancing it against other non-correlated stuff. Volatility drag is basically, when you 2x an asset class, what tends to happen is your variance goes up by 4x, and your compound rate of return is the variance of the portfolio. It's half the variance is your arithmetic rate of return minus half the variance of the portfolio, right? So what you end up getting penalized if you are just owning that asset at 2x the volatility. But that doesn't just apply to 2x S&P or 2x gold. It applies to 2x anything. If you are increasing the volatility of your portfolio, whatever it is, you're increasing the variance and you are getting a drag from the compounding of or negative compounding of that, like that variance drag. But if you are increasing leverage in order to have a more diversified portfolio, we use the example in one of the podcasts that we did where you talk about the 2x S&P 500 versus stacking 100% S&P and 100% trend following, for example. When you stack 100% S&P, your volatility is actually you're not getting twice the return, and your volatility is doubling. When you are stacking a non-correlated, what we call defensive leverage on top, you're stacking the return, but because it's non-correlated to the underlying asset, you're not increasing your necessarily the standard deviation, and therefore your variance drag is much lower. Okay, and so it just the answer is it depends on how you use it. Okay,
Yeah.
so use it for portfolio construction, use it to create robust portfolios, make sure you're rebalancing. And if you do it, it's a great instrument. It's volatility that you can use to create rebalancing premium.
Those I would add one final, UGL, that type of thing where it's 2x of the same asset. Those are often trading assets. So you should be engaged in the trading of the assets. As you've mentioned, they re-gear up every day. So if you make 10%, they're going to re-gear that up tomorrow. At some point, you get lots of leverage built into your position, and you have a correction, and that's where you get that volatility drag. But if you were harvesting that and saying,
That's
well,
right.
no, I'm going to trim a little as it goes up, and then I'm going to add a little when it goes down, you can attenuate that. And you might do that with cash, you might do that with other assets. It's all fine, but it does require the leveraging is daily, and the asset is somewhat volatile at times. So it can require adjustments daily. If you're doing that type of thing, it's fine. Certainly when we're looking at futures contracts and things like that in portfolios that we're managing, those are reviewed daily and are rebalanced, brought back in line on a regular basis, because the volatility with the leverage and the other pieces of the puzzle, right? The other positions in the portfolio.
Look, when it comes to leverage, we always talk about internally that you don't want, when it comes to leverage, you don't want LICE. And LICE stands for leverage that is illiquid, concentrated, or excessive, right? So in this case, we're talking about a liquid product, but it is concentrated and it can be excessive depending on how much you put into it, right? And so you just want to avoid LICE when it comes to leverage. And what you really want it to be is part of a portfolio, or you want to stack it with other things. And if you're going to use leverage, use what we call defensive leverage, things that are non-correlated to the main stack that you're going to use. So if you keep that in mind, you're going to minimize the chances of blowing up. All right, we're coming up to an hour, Mike. Anything that we may have missed that you want to chat?
No, I think we've covered just about everything that we wanted to discuss. I think the report is well worthwhile. We've got one of the portfolio managers at Incrementum that's going to join us in June, and we'll take a little bit more into the report itself and talk a little bit more of the intricacies of the gold market itself, things where we'll learn some stuff as well. So look forward to that, and look forward to tuning in with that. And I think, the other thing is, every year that he was in talking with the guys over there, they've noted that every year when they launch the report, gold goes down. It's just,
what do they say?
like,
They launch it into a poor seasonal period, or like
exactly
seasonality. And I think gold is entering a poor seasonal period, which is going to be a great entry point.
Exactly. Start your allocation today. Go slow, go steady, get the intuition. You're going to see that public opinion. This is, for what it's worth, from my perspective, public opinion is changing. We're entering that public phase. We're seeing that in the AUM growth in the ETFs. So it's something to look at and consider, and how you might allocate to that is, there are many ways to slice that sandwich. We would encourage you to look at the idea of return stacking as a way to incorporate it. And if you have any questions, as always, reach out to us. And
well, we got a couple of minutes, and there's a couple of questions that I do want to answer.
Oh, great.
Sorry, they were talking about borrowing costs, right? So it depends on how you borrow. You can get, again, if you're using, there's a bunch of product out there that is helping you create capital efficiency by making your portfolio, by giving you like Wisdom Tree as a 90-60, right? You're getting leverage at the cheapest possible level of on the futures markets, right? So yes, what you're going to need to decide is what you're stacking. Is it likely to do better than cash, right? And what we've seen, what we've shown you from gold, is that gold has had positive real rates of return. So when you think about creating portfolios, especially in the context of return stacking, it really is like, the way I think about it is Lego blocks, right? See if I have different colored Lego blocks here. You have your equity. I do want to find that third color, but let's assume that you got your equity risk premia that you are going to buy and get exposure to. You're going to get your bond risk term premium that you're going to eventually, over the long term, get paid for taking duration risk. And then let's say that's a 100 portfolio. Then you got to decide, okay, what excess returns can I count on to be there? Well, it turns out that gold has had pretty decent excess returns in the last 40 years. So then whatever excess returns that in, you're stacking that return on top. And then you find another thing that you want to stack, whether it's managed futures trend or merger arbitrage or market neutral portfolios. You can literally decide to stack all of these different risk premiums that are non-correlated to each other to the level of portfolio volatility that you can stomach, right? So yes, everything costs to stack. It's always the risk-free rate. But every asset that we've discussed today has had a long-term excess return above cash. And if you feel like you can count on that over a long enough time horizon, then really you're just stacking excess returns plus the cash premium you get on your core holdings, right? So hope that answers your question. And yeah, if you guys want to reach out and ask any further questions, you can reach out at Rod Gordillo P on Twitter. Mike, what's your handle? Mike 99, is it still?
Mike 99.
Yeah, Mike, that's his football jersey.
Mike Philbrick 99.
Mike Philbrick 99. And please, this is not investment advice. This is just a couple guys talking about some research that we thought was interesting to share, and be happy to discuss further offline for anybody who wants to do that. And looking forward to that gold conversation continue in June, Mike. Thanks for it was your initiative. I really enjoyed this conversation. Thank you for that.
Absolutely. Stay diversified, everyone.
All right. See y'all.
See y'all.
If you're enjoying the podcast, please consider heading over to your favorite podcast platform and leaving us a rating or review and sharing us with friends or on social media. It helps new people find us and helps us grow. Finally, if you'd like to learn more about our extensive research on the concept of return stacking, please do head over to returnstack.com.